The final live virtual panel of the day examines contingent risk insurance for M&A and how to protect a deal in these uncertain times. Catherine Ford joins us again, and she's joined by Willis Towers Watson, Wolf Tice and Dual for our final panel discussion. Over to you, Catherine.
Great, thank you very much. And hi, everybody. Thank you for sticking around for the last session of the day, where we are going to be talking about M&A contingent risk insurance, one of the markets that is becoming more and more important as we go along. Start with the discussion specifically about the content. I'd like to ask my panelists to introduce themselves. Stefan, maybe I can ask first of all for a few words of introduction from your side.
Absolutely. So my name is Stefan Farahani. I'm at Willis Towers Watson, which is a global leader in risk consultancy and insurance broking. We have offices all over the world, including across the CEE region. I've been at Willis Towers Watson for about 5 years and lead our tax and contingent risk insurance. And prior to that, I was a tax lawyer at Slaughter & May.
Brilliant. Thank you very much. Then we have Justin. Justin, can you tell us about how you fit into this conversation?
Yes, good afternoon, everyone. I'm Justin Ansell. I'm at Dual M&A. We are a specialist managing general agent, which means that we use insurance capacity to insure risks on transactions. Like so many in this market, I'm also a former lawyer. I've probably been out of the market too long to say I'm still a lawyer. But the team that we have focuses now on a complete range of risks, from the unknown risks, the warranty and indemnity type risks, all the way through to specific known litigation, all the way up to, for example, European Commission appeals. And as a result of that, we're going to focus today, I think, on the contingent risk side, which is the known risk side.
Okay, thank you very much. Markus, before I ask you for some introduction, I'm hearing some feedback on the line. Can you guys hear that as well, or is that just me?
Yeah, no, I can.
Okay. Now, whatever you've done, Justin, that's made it stop. Markus, a few words of introduction from your side, please.
Hello, everyone. My name is Markus Bruckmüller. I'm a partner at Wolf Tice, an M&A lawyer for almost 20 years. I'm admitted in Austria and Slovenia, and I'm heading our Slovenian office. In Slovenia, I have advised on a couple of M&A deals just recently, where we have also worked with warranty and indemnity insurance, and also with contingency risk insurance. Mm-hmm. We have seen that in a couple of different sectors, both in financial industry, real estate, production, healthcare. So I think this insurance has become an interesting product to be used in M&A transactions.
Great. Thank you very much for those words of introduction from all three of you. Now, I know that for many of the people viewing this, you will have specific questions relating to individual deals that you are working on. If you would like to ask questions, specific questions, please do so, but via the question button at the bottom of your page. But also, all the three gentlemen will be available to take questions separately if you want to get in touch with them. Let's jump straight in. And can I ask you for an introduction on what on earth is contingency insurance? I know a contingent risk insurance. I know that M&A insurance has become one of the key items in the M&A toolbox, but there is still some confusion and some education to be done around the topic. So maybe, Stefan, I can come to you first of all. Talk to us about what it actually is and why are clients increasingly seeking to outsource that particular risk.
Yeah, absolutely. I mean, contingent risk insurance is a bit of a catch-all phrase for insuring identified problems or issues. So most insurance covers kind of the risk of certain issues popping up, but unknown issues, whether your house burns down or whether you have an incident on holiday. This is where you've got a known problem. So you know, to some degree, the kind of house is already burning a little bit, and you know you've got an issue, and that doesn't mean that every potential risk is potentially insurable, but it's appropriate where you can see there's an issue, but you can also see there's sensible, rational reasons as to why the problem should go away. So it covers the wacky and the wonderful, and I know we'll cover those. But and I know that's not a very tight description, but it is.
The wacky and the wonderful. Talk to me, what is that precisely? I mean, I feel that my world is wacky and wonderful enough as it is at the moment, but what else is there out there?
Oh, I mean, we've done, we'll touch on it, some really interesting things to do with, whether military bases are going to have to close, or, the consequences of certain employment consultations, or what do you do? How do you show title to the company you own when it was gifted by the royal family 20 years prior? And, so like really wacky and wonderful stuff sometimes, as well as more benign. But to the point why people are, increasingly covering it. I mean, it's quite a neat solution, and it didn't really exist meaningfully 5 years ago. So I think people are just becoming more familiar with it. But what COVID has done is also has brought risk really into focus. And we see that for all businesses, whether they're in the function of M&A or not. And investment committees are really going risk off on some of these identified big ticket items where there's a low probability of it manifesting, but a really severe loss or damage to the investment if it manifests. So investment committees are, being cautious, and lenders are similarly being cautious. And I think we heard that on some of the panels earlier today. There's still money out there, but lenders are being cautious as to how they're using it. They don't want to, there's enough risk out there with COVID in terms of cash flows. They don't want to be taking on litigation risk and tax risks and other, the wacky and the wonderful ones. So that's, to my mind, why this product has grown in terms of utilization.
Okay. Justin, can I have some words from your perspective before I talk to Markus about some of the specific circumstances that this product is being used in?
As Stefan said, that there's quite a broad spectrum of risks that can be insured. I think the real point for us is number one focus is about motivation. It's not about the risk itself, because I think clients hear that we can just insure any known risk, the burning house, if you like. So I think the starting point is, what's the motivation? Why do you want to insure something? And there could be significant commercial benefit, for example. It could be that release of funds early rather than waiting for an issue that's uncertain in time or uncertain in quantum to come to fruition. So there's got to be some good reasons there, and that's the number one priority. And I think then the other thing that characterizes successful policies like this, if you like, from all parties concerned, is broadly there's got to be a relatively low chance of success, a low chance of the risk actually happening. If that building is already almost burnt to the ground, to keep using that property analogy, no one's going to step in and look at it. These are things that, it really is that spectrum of risks from you've got an increased concern about something where you really want some protection, or you've got some additional people involved, whether it be the lenders, whether it be your investment committee, whether it be a counterparty who's got a different risk appetite to what you've got. And now you can start talking about, okay, how do we use insurance to protect against that particular risk? So rather than focus on what risks fit within the category of specific risk, focus on why do you want insurance? It's the motivation.
Okay, thank you very much. You've mentioned the issue of risk appetite. Stefan mentioned also that in the COVID pandemic that we're finding is at the moment, people are keen to take, risks out because there are so many risks that they can't actually take out. Markus, can I talk to you about that? Where do you see the risk appetite being? Do you feel that they are being more cautious? Do you feel that it is something that is becoming an increasing concern? But also talk to us specifically to the topic of contingent risk insurance. Under what circumstances are your clients applying this particular tool?
Well, what we usually see in Central and Eastern Europe is that there's still sometimes certain legacy of unresolved issues, depending on where and when and how the privatizations happened a couple of years ago, how and when and in what way, for example, the land books were reformed. So it could be that the title to a certain property is still not registered in a correct way. And if this is title to property which is core for the business, then it's necessary to look also for other solutions other than just waiting until the deal can close, because that can be unsatisfactory both for seller or for buyer. Then there can be other situations. For instance, after the financial crisis, there were certain reforms made in several jurisdictions where investors and shareholders lost their shares in certain companies and also lost their position as creditors under subordinated debt securities. Here, certain litigation is pending, but it's very uncertain how it will develop. This is also certainly an area where there is a risk which investors become more and more aware. Other risks are somehow more of something which we would also see in Western European countries, certain litigation ongoing, then certain risks because overtime or social security payments have not been paid by the target company. So these are risks which are being taken into account. And now, of course, in the negotiations, seller and buyer then negotiate who should bear that risk. Should it be the seller who should grant an indemnity? For what time? Should it be kept, etc.? While the buyer would then need to reduce the purchase price if he or she would want to factor that risk in, which also is not satisfactory for the seller. So here usually then one of the parties suggests that an insurance company should be, or a broker should be contacted to see whether this is a risk which in principle could be insured and for what price.
So who is the driving force in this then? Where are the inquiries coming from, Justin and Stefan?
Well, from our perspective, we typically, we sit as the broker. So who's picking up the phone to us?
Yeah.
Generally speaking, it's if there's already a relationship there, it would be the funds, the people working on the deal, because they are the people most familiar with the risk that they feel that they can wear and the risk that they don't want to wear, or they know is causing a intransigent problem on the deal. But equally, often it will be the corporate finance advisors or the lawyers. It's anybody who's all the participants, whether it's the advisors or the funds, they want to get the deal done. Everybody, walks away happy and is getting paid if the deal gets done. So really everybody, who spots the issue is generally quite open to just picking up the phone and then seeing if there's a solution, because there won't always be a solution for some of these problems. But you only find out by kind of starting that discussion.
What are the kind of problems with? Oh, sorry, Justin, you go.
So I was going to say, I think that's right, and I think that we've seen a lot of interest from the private equity community, as financial investors, and but also equally from the corporate world, and they have different requirements for why they want the issue covered. And they each get different, different benefits, if you like, from the insurance. But, as Stefan says, the key is getting the deal over the line. Everyone wants the deal to be done, and they don't want an issue, if it can be transferred to insurance, to hold up that deal. And I think part of that is, addressing that issue as early as you can in the process, because, these are complicated risks and have no doubt been, a particular issue for some time pre the deal happening, as part of getting their house in order, as well as part of the actual deal process.
So this is no longer a tool that is being primarily used by private equity funds, because when we started initially talking about M&A insurance, it was definitely something that private equity funds were using, allowing them for a clean exit out of a transaction. And then we saw this being increasingly picked up by corporates. But I remember when we spoke about M&A insurance the last time, in Warsaw, it was still something where corporates said, yes, we're using it if a private equity fund is involved and if a private equity fund is specifically asking for it. But it sounds as if that has now changed. Is that right, Justin?
Yeah, I think that is right. I think that there's different requirements, and I think on the unknown side, where you've got the sort of mainstream warranty and indemnity insurance, which is becoming far more prevalent, certainly in Europe and now in Central and Eastern Europe. I think that is still the domain of the private equity world, or at least driven by private equity, where they're not willing to actually stand behind the warranties that are given on a sale. But I think on the specific risk side, it's a bit more focused, a bit more targeted. You have a corporate that has an issue, and you've got a finance director that's got to sort out that issue in order to maximize value. It comes to our market as much as it does if it's driven by private equity.
Okay, that's good to know. Thank you very much. Now, Markus, I'd like to bring you into the conversation and ask you to talk to us about some of the deal blockers that you're seeing. What are situations specific in the CEE region that you've encountered where actually, if you flag those up, then there's no going forward, really?
Well, it's hard to say because there is no general blocker. There are individual situations. I think that simply a legal risk usually is not a deal blocker. The deal blocker usually is a bad financial situation of the target, or lack of liquidity, or just the product not being attractive for the market anymore. Which obviously is something which an insurance company would not insure. But what we've rather seen is that the risks which were identified as a difficulty in the deal were side risks which were not related to the core business of the company. But for instance, a state institution suing the target company. This obviously is a risk, but you can overcome that by a certain risk allocation. Then, as I already mentioned, the real estate risk in our region certainly is a difficulty. Sometimes, of course, the situation in the land book is still so messy that you would not continue with the deal. But also here, there are solutions available. My personal experience is that investors who would look at the target and identify a certain difficulty, which is not only legally related, would discontinue without involving a law firm already at an early stage.
Okay. And can you talk to us a little bit more about risk appetite? If you cast your mind back to sort of the conversations that you were having pre-crisis, so early on in the year and the tail end of last year, do you feel that the risk appetite from your clients has decreased over the course of the last 6 months?
It has changed. There are more questions asked. Due diligence is also carried out in a more detailed manner. Because also the managers, the investors have to make sure that the risk allocation is properly made, and that they have identified all the risks. What we've seen during the year, also after the start of the COVID crisis, is that insurance products have certainly added value in transactions, because the risk allocation was then agreed in a way that, in particular, when certain risks were already identified, that there must be a clear solution for that. And if it's a third-party insurance covering for it, then it's also something which the parties are prepared to pay for.
Okay, thank you very much. Justin and Stefan, would you like to add something to those 2 points?
Yeah, I mean, well, we've seen real deal blockers. I mean, really profound deal blockers have often come in the context of carve-outs. So, you do an incredibly deep DD on your target business. You're super satisfied that it's a well-run business, no big risks identified. But it might be being carved out of another business that does have issues, and depending on the subject matter, quite often they can, through no fault of the target business, essentially infect the target business. So that could be a pensions risk, or a secondary tax risk, or a litigation risk where the target business might be added as a co-defendant. And that's something which is really difficult, because how do you kind of value that? Well, you can't really, because it can often be quite binary in outcome. And you can't easily deal with it through contractual remedies, because the time when the risk is most likely to manifest is when the indemnity from the seller is likely to have very little value, i.e. when they're in financial distress. So those are areas which actually have we've seen have really inhibited deals.
Yeah.
And where insurance has been quite an elegant solution. But I agree with Markus, you know, what people are focusing on is doing their DD, trying to find whether there are risks, because, you know, nobody wants to buy something with lots of problems, whether it's got insurance or not. So the insurance is usually being used where you have well-run businesses that have one or two issues, rather than businesses that are just, you know, a basket case.
Okay, thank you. Justin, would you like to add to that?
Yeah, I mean, I think I'd also say that the sort of current COVID sort of crisis has slowed down the timetable for so many deals. They've been put on hold. And because of that, there's been a focus or refocusing on how do private equity particularly release funds that have been tied up. And to the extent they have been, how can they get those funds out? And if there's some legacy issues there, let's address those with some insurance, so that sorry, my screen went then. How do they address legacy issues so that the funds can then flow? So focus on releasing the funds whilst the deals, the current pipeline of deals, has been put on hold as a result of the crisis.
Okay, thank you very much. Now, let's talk about some of the examples, what was it, wacky and wonderful, as Stefan said. Talk to us about some of the examples. I'm really intrigued now, what you've got up your sleeve as examples of some of the risks you've insured over the last couple of months.
Shall I kick off with one? I mean, we've done ones where people have been buying a portfolio of financial instruments, so loan notes.
Yeah.
Because, you know, it sounds silly, but because essentially some administrative paperwork and filings weren't completed on a timely basis, there's a risk that the loans are worthless, which is quite daunting if you're, if you're
really scary.
You know, for 50 million, these performing loans, so that, you know, the interest is being paid on a quarterly basis. You have, you know, good portfolio of loans. But because of this technical defect, you know, under the domestic legislation, you can argue that, you know, that the loans are, you don't have an obligation to repay. And we've done a couple of those actually. You know, you would be surprised just how common that can be, both as an issue and people not getting it right. So that's a recent example from us. I don't know if Markus, Justin, you have any other ones?
Yeah, we've certainly been doing with some transactions relating to renewable energy. I mean, it's a big focus across Europe at the moment with the increased targets that countries have pledged to hit. And you've got the twofold issue there. You have on the one hand, you have certain regulation which is not 100% clear, and then on the other hand, you've got investment from banks into the finances into these transactions, where the only sort of cash flow is going to be from the feed-in tariffs that those renewable energy deals generate. So there's a lot of nervousness around them, and we've insured a number of transactions, you know, wind farm related, solar panel related, that really they back up the feed-in tariff. And again, it's coming back to what I said at the start. Look at the motivation. It's not about necessarily a real concern over the risk. It's about how do we get the lenders completely comfortable with the risk? How do we get them to lend at a sensible rate? And if insurance can reduce the cost of borrowing for a particular developer or project owner, you know, that's a fantastic motivation for them, and it's a significant commercial advantage. So those are those kind of risks are what we've been seeing quite a lot of recently.
Okay, thank you very much. Markus, anything to add from your side?
Yeah, I mean, we still have the situation in Slovenia that the land books are very, very slow.
Yeah.
Which means that once a transaction closes and the change of the title is being applied for at the land book, there is usually a time lag between 2 and 6 months until the buyer actually becomes legally the owner in the land book. And in a large transaction, which was also financed by third-party lenders, it was necessary to make sure that this risk is somehow reflected in the transaction structure, since the sellers in Slovenia always expect to get the money once the application is done in the land book, and not only at the time a few months later when the title is actually registered in the land book. So we work together with an insurance company to ensure this gap, so-called gap insurance. And the good thing for the lending banks was that it could also be extended to the banks for the time gap, because also the mortgage not become registered until the title was registered. Okay. So this was a solution which actually also helped successfully closing a deal in Slovenia.
Okay, thank you very much. Now, I'd like to sort of spend the remaining time doing a bit of a deep dive on sort of how this actually all works, because I know from some of the conversations that I've had on the sidelines of events, when it comes to the topic of insurance, there's a huge knowledge gap. There are some people who use it on every deal and who do lots of deals and therefore know an awful lot about it. But there are also lots of players out there for whom an M&A transaction is sort of a once in a career, twice in a career experience, and they don't actually know that much about it. So let's do a one-on-one on risk insurance. Stefan and Justin, what's the difference between the two of you when it comes to M&A insurance? So Stefan, what do you do versus Justin, what does he do?
Well, from my perspective, whilst we would have a good working relationship, we're fundamentally on other sides of the fence. So my job is to work with people who have risks and find a suitable counterparty to put it on their balance sheet. So presenting the risk in an appropriate fashion and finding out the right people to speak to, and frankly persuading them that it's a good risk for them to put on their balance sheet. So we act for the person seeking insurance, trying to get them the best coverage, the best rates, and getting it executed as quickly as possible within the deal time frame.
Okay, Justin, talk to us about your role.
Yes, we're the other side of the fence. We're the insurer. We're taking on the risk, and our role is to protect that capital that we're putting down. But at the same time, we've got to, our job is to take risks onto the book to provide a commercial solution. So, our key thing is underwrite the risk, assess it, put it on the books, and then, of course, dare I say, at some point, our role is to pay claims, which is the outcome of the product, I guess, for the client.
We'll talk about claims in a minute. Markus, talk to us. One of the concerns that does come up quite consistently when it comes to the topic of insurance is, how long is it going to take me extra? Is this something that's going to add massively to an already tight timeline? And also, how much is it going to cost? Are those two areas of concern for your clients, or is it one of those things, well, we have to have insurance and whatever it costs and however long it takes is just something that we're going to have to suck up?
No, you have to manage the client's expectations as always. It is some clients already used to normal warranty and indemnity insurance. They know it's a separate work stream. They also know that insurances do not insure each and every risk, and it's subject to certain carve-outs. For a particular specific risk which has been identified in due diligence, the good thing is that there is already some paperwork which has been done. And usually it's then the broker who, based on this information, contacts the underwriters. And usually that's something which does not take too much time, because the teams, both at the brokers and at the insurance companies, are highly professional, former lawyers. They have a very, very short response time when it comes to a first assessment of risk. However, of course, as it is a risk, it needs to be analyzed. And an insurance would, if it's a more complex thing, usually involve their own team of lawyers who have to have a look, also have to make the risk assessment. Sometimes it is helpful to get already a first cost estimation from an insurance company, but they sometimes say, or usually say, it's subject to due diligence and underwriting. It's just the first step. Which then gives an indication to the client whether it makes sense to continue or not, given the size of the risk and the nature of the risk.
Okay, Stefan, timings, how long does it actually take you?
So from someone picking up the phone to getting an indication on pricing is typically about a week.
Yeah.
And then to actually get from there to, a negotiated policy could potentially be done in about another further week.
Okay.
In practice, it often takes longer because information flows slowly, deal timetables slip. So it's not uncommon for it to actually inevitably take, materially longer than that. But what everybody in the insurance process strives to do is make sure that it's not the insurance delaying the deal. So if it takes longer, it's typically because the deal is taking longer, the DD is going slower. Yeah. It's not uncommon for people to pick up the phone to us on the Thursday and say, we'll need to know today or Friday how much something's going to cost or whether it's insurable. And frankly, as a broker, we can often give a good steer, but in order to get terms from an insurer, quite often that's just not realistic. We are often asking insurers to take, a significant risk on their balance sheet. So 50 million, 100 million, big chunks of money. And so it does take a few days for insurers to get their head around that and to, get familiar with the risks. But generally, I'd say, the key thing isn't how long the process takes. It's pick up the phone as soon as the risk is identified.
Okay. So don't wait till you're on the home stretch, is what you're saying.
Yeah, exactly. There's no cost for finding out whether something's insurable. So picking up the phone as soon as possible is definitely the way forward.
Okay. Justin, talk to us from your perspective. What sets you on edge when it comes to the timing of placing an insurance or taking a risk on, and also talk to us about the cost that's associated with it.
Yeah, I mean, I think as Markus said, it's about expectation management really on the time, and it really does depend on the complexity of the issue. And I think the advisors know, and so do their clients, that when they've been battling with an issue for several months and have still not managed to resolve it, coming to an insurer and expecting them to sort of analyse it within 5 days and turn it around and negotiate a policy is probably unrealistic. But look, everyone in our market is professional, and this isn't home and motor insurance. This is a specialist line where most of the people have been involved in M&A either on the advisory side or the actual deal side. So we try and do it as quickly as possible. And as Stefan said, we don't ever want insurance to hold up the process. But pricing is, there's a number of factors that go into price. There's probably sort of three key factors. I think the first is the risk itself. We take a view of whether we think that, where on the spectrum is the risk in terms of the likelihood of loss. That's normally a very, very difficult question to answer. And if it's some live litigation versus something that's not been discovered yet, but people have just got a heightened awareness, there's a complete change of sort of range of prices. I think the next thing is probably, as well as the risk itself, it's the time it takes to actually analyze the risk. What's our underwriting resource going to be like? Typical, if it's something that we're very familiar with and we can analyze quickly, that's going to be cheaper than something that actually is a huge volume of data or a huge range of jurisdictions, for example. And then I think the third thing, and actually probably the most important in pricing, is what's the commercial benefit of the insurance to the client. If it releases funds early and they're going to be able to make money from those funds, then we're going to price it at a different rate to, for example, they have a letter of credit from a bank and they're trying to release that letter of credit.
Yeah.
We've got to come in cheaper than that in order to make our insurance attractive.
Yeah.
And actually, pricing is not as necessarily based on the risk as you think, and we take a commercial view. We know what we're competing against, not so much other insurers, but other products or other avenues of recourse that the client has available to them, and we've got to compete against those, whether we like it or not.
Okay, thank you very much. Before we round off the conversation with a look at claims, Markus, what do you say to your clients when they're talking about insurance? What documents, what things do they need to have in place to make this process run as smoothly as possible?
Well, obviously it helps if the buyer's due diligence has been done properly already, and if there is enough time and enough resources have been allocated to the process. Then it depends also on the dialogue with the sell side, how much information they were prepared to give, and if it's already clear from the negotiations that this will be an area of risk which will be subject to negotiations in some way or the other.
Yeah,
it is probably fair also to expect from the seller to provide as much information as possible. For instance, if there is a litigation pending, you would expect to see not only a summary from the law firm representing the seller, but in fact the entire file, so that you can have a look at least of what has happened in the file, the lawsuit, response to the lawsuit.
Yeah.
And then that you can also then understand where the litigation stands. Has it already been decided in the first instance? Are we only waiting for the decision of the appeal court? So these are certainly things which have to be disclosed by the seller as soon as possible. And if there is then a good summary and a good risk assessment, that's certainly the first paper which then can be shared with the broker or the insurer. And then in the next step, obviously the law firm of the insurance company will have another look at it. But if there is already, let's say, a separate section in the data room where the insurer's law firm can then access and also have a look at the papers, then the process certainly runs in a smooth way.
Okay, thank you very much. Justin and Stefan, is there anything that you'd like to add to that? Any sort of paperwork that you're like, don't even come to us without that in your hand? Or, you know, something where you say like, this would be great, no one does, but it would make us really happy?
I mean, each risk is different. That's the nature of the beast for this type of insurance. So the documentation that will be required will vary. But as a starting point, if the risks that are insurable are ones where you can make sensible arguments, sensible reasons as to why it's unlikely to manifest. So we need somebody who knows something about the subject area to write down what those reasons are. It might be a lawyer, it might be a financial advisor, it might be a litigator, it might be a tax advisor, but somebody who knows, about this subject area, putting down their thoughts. And it might be in an email, it might be a formal memo. We don't care what it is, but we just need somebody to kind of put down on paper the kind of expertise they have in their mind.
Okay, thank you very much. Justin, anything that you'd like to add to that?
Yeah, no, I think I agree with all those comments, really. I mean, it's we're open to being pointed to the key documents. We don't want to repeat every bit of due diligence that's been done. The client's advisors are good at their jobs. They know what they're doing, and when they come to us, present us with all the information, but highlight the things that you want us to really focus on and build your cases to. This is a low risk. We want to insure it because just lead us through it, and it saves time.
Okay, thank you very much. Justin, talk to us about claims, because this is the thing where people always say, well, that's all fun and games, and yes, I'll take out the insurance, but how often do you actually pay out?
Yeah, so look, claims is always on everyone's mind, and we hear it so often. Do you pay claims? Yes, of course we pay claims. We're in the business of paying claims. Yeah, exactly. And if we didn't, I think so much of claims is based on people's personal experiences. Everyone's had an insurance claim at some point in their life, and they tarnish everyone with the same brush. Look, I think the starting point is these are negotiated policies, and so the policy wording should be clear to start with, and it's an equal policy. We've had the client and their advisors walk all over the policy. They've got the wording how they want it. It's clear. And it's clear on the claims process. The claims process is set out in the policy, and we want it to be as easy a process, if you like, and as clear a process as possible. We like to be involved. Typically, the claims process involves the client and another third party. Someone's made a claim against them, or someone is challenging, as Markus sort of alluded to, sort of title issues or ownership issues of assets. There could be some litigation. We don't want to take over that process. What we want to do is be kept informed, and we want to help the client through that process. And the claim under the policy is normally the successful claims are where we've got a narrow policy trigger, a narrow definition of what the issue is that we're covering. and the claims process is going to happen behind the scenes. We're not looking to take over the court process. That will happen. The policy pays out when that court process has come to an end, and unfortunately our client is on the wrong side of the court decision, for example.
Okay. Great, thank you very much. Now, there are no questions from the audience, but I'd like to wrap up this session just asking each of you for your outlook on the industry for the next sort of 6 to 18 months. Markus, maybe I can start with you.
I think that in light of the COVID-19 crisis, many of the transactions will be negotiated and prepared in a very cautious manner. So I think both for sellers as well as for buyers, insurance will always be an additional option as to how to make a deal easier and how to allocate certain identified risks. So I think that the outlook for the industry is that there will be more work to come.
That's reassuring for you guys, at least. Stefan, final words from your side.
Yeah, absolutely. I mean, I think the product's going to continue to grow, and that's largely because knowledge is a one-way street. So people have become aware of the product. Once they're aware of it and have used it, they're highly likely to use it again. So in that sense, I think it will grow. I think risk appetite isn't suddenly going to change, even with the kind of COVID vaccine. It will take time. So I think that also is helpful. But I do think we were also going to be hit by more claims. So from an insurer's perspective, we'll have to see how their appetite changes. And again, the role of the broker is to find a home for each risk. So I do think that might be a trend that we see over the next 12 months.
Okay, thank you very much. And then final thoughts from Justin.
Yeah, I think this market is growing, and I think that the market is becoming more sophisticated. I think we've got an appetite for looking at a wider range of risks. I think that the pricing is now at a level which makes this a commercial option in the deals that are happening. And I think that the insurance capital is there to really take on these risks, and hopefully that's going to promote the market and make it a more streamlined process for the client.
Okay, great. Gentlemen, thank you so much for sharing all your insights into the market and the product. I'm sure everyone has learnt an awful lot over the course of this panel discussion. I hope to see you all in person next time when we get together in Warsaw. And until then, I wish you all the best, and I hand over back to Juliana in the studio.